The theft loss deduction, I've got a chart that we're going to put up on the screen for a minute, just so we can get a picture of, in its simplest form, what the recovery looks like. We've assumed a taxpayer who put $1 million with Bernie Madoff January 1, 2004. Over the year 204, 205, 206, 207, he made a total of $500,000 on that. He paid tax on that $500,000. And in the year 2008, he now finds out he has a theft loss, and he deducts $1.5 million in losses. The principal that he put in and all of the income, whether it was true income or phantom income that he paid taxes on. Well, that $1.5 million is going to go to work right away, because in the example, we've assumed that this taxpayer has $300,000 a year, steady income from another source. Well, the $1.5 million in 2008 is going to be used to offset any tax on that $300,000 he's got coming in from another source. He then has $1,200,000 in losses left. And we see in the chart, he's going to go back to the year 2005, where the $300,000 in steady real income and the $120,000 in phony Bernie Madoff income, where he paid tax on $420,000, and now he's going to take a loss of $420,000 and get all that tax back. And then he'll move forward and use that loss up going forward. So that 3-year carryback means money in the pocket from claims for refund. Now let's see how we get a handle on what the real loss is in the theft tax loss. The real loss is not your economic loss. The real loss is your tax basis, is the loss of assets that you have a tax basis in. So, for example, in our last example, we had somebody who put in after-tax money, an investment of $1 million, paid tax on $500,000. That's a real theft loss of $1.5 million. However, take that same money and have it be a taxpayer who put it in an IRA or a profit-sharing plan, never paid any tax on it to begin with, then had $500,000 of Madoff income or phony income. Now it's 2008. He's ready to retire on his steady return from his $1.5 million that's been built up. He loses it all. There's no tax loss because he's never paid tax on any of it. It was the income from Madoff was tax-free while it was in the IRA, and the money that was put in the IRA was free of tax. So no tax basis. So first, everybody's got to get a real handle on the losses. The major thing that everyone really has to be concerned about is the timing of the theft loss deduction. This is going to mean tens, hundreds of millions, billions of dollars. And get the timing right. For most people, that's going to mean take this deduction as much as you can in 2008. So you'll be able to carry it back, come to quick refunds, and put it behind you.
Well, clearly we're in a situation where here in South Florida, we've got hundreds, maybe even thousands of people that are caught up in this. I'm going to do a series of shows with you gentlemen in the next few weeks. We're going to cover all these points. We couldn't possibly fit it in 1/2 hour. So next week, we'll be discussing the 2009 forecast for the markets and the economy. If you'd like more information on this show or any show, go to the Wealth and Wisdom website, www.xel.org. Thanks for watching. I'm James DeGeorgia for the Market Guys. Good night.
To receive a copy of your favorite Wealth and Wisdom episode, or if you have a question or comment about our program, please feel free to write us at Wealth and Wisdom, care of WXEL, P.O. Box 6607, West Palm Beach, Florida 33405. Or call us at 1-800-915-9935, extension 4477. We look forward to hearing from you soon.